Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, with a federal budget just days away, we're taking the pulse on the Canadian economy and asking what the right balance is between spending and saving for government, plus money for housing and nothing for free, solving a big affordability problem. That's all ahead. First, for the week that was in business, it's time for the briefs. Interest rates remain at 5% in Canada as our central bank stays on hold, but indicated it sees progress on inflation, expected to be 2.2% by year end. But while Tiff Macklem said the path of inflation is encouraging, he wants to see more progress.
We are seeing what we need to see, but we need to see it for longer to be confident that the progress towards price stability will be sustained. The further decline we've seen in inflation is very recent. We need to be assured it's not just a temporary dip.
Meanwhile, U.S. inflation rose again in March to 3.5%, which has expectations for lower rates in that country being pushed later in the year. The strength of the U.S. economy has been a surprise, and for its central bank, a partly unwelcome one. In the Tell Us Something We Don't Know category, Canada's housing affordability problem is only going to worsen if more isn't done to change it. Analysis from RBC suggests we aren't building nearly enough and that construction would have to rise 1.5 times above the current level to put a dent in our supply problem. A lack of skilled labor was identified as a key part of the issue. The number of Canadians who worry they can repay their debt is falling slightly. A recurring survey from MNP showed that 58% are still concerned, but that's down from 63% previously. And the prospect of lower rates has many debtors feeling more optimistic about the year ahead. More turbulence for Boeing as a whistleblower accused it of shortcuts on assembly of its 787, warning that parts of the fuselage could experience fatigue, words flyers probably don't want to hear about their airplane. Boeing denies the claims. There are 1,000 787s in circulation. And those are your business briefs. With the budget ahead, thoughts of spending and saving come to mind. So what do we know about next week's budget? Here's a look by the numbers. First, avoiding a recession seems to be in the cards for Canada. Growth last year of 1% was slow, but still positive, although per capita GDP, taking into account our growing population, is less rosy, down 2% from 2022. The federal government heads into this budget period with a $35.3 billion deficit. Total spending was $473.5 billion, and revenue was $447.8 billion. Of those expenses, $35 billion is interest payments on public debt. That makes it the second biggest line item after spending on the elderly and healthcare transfers. Previous healthcare promises mean that health transfers will grow from $49.4 billion last year to just shy of $63 billion by 2028. And there's spending that's already been announced for this budget, like $5 billion for provinces to build housing and $1 billion to cities for housing-related infrastructure, $1.5 billion in the Canada Rental Protection Fund, intended to protect existing affordable units and build thousands more. And there will be $8.1 billion over 5 years in defense spending, including new support for military housing. The government has also said $2.4 billion will be set aside for artificial intelligence, with the bulk aimed at promoting research and startups in the sector. One thing in the government's favor as it prepares a budget is that the economy has slowed but has avoided a recession so far. What's less clear is how much growth we have in store in future. Pierre Cleroux is chief economist at Business Development Canada. Thanks for being with us. Pierre, I wanted to start with the surprising resiliency of the economy, especially in the U.S., of course, but we're seeing it here too. We didn't see a deep recession, and we maybe aren't seeing a recession at all. Were you surprised by that?
Yes, I was a bit surprised. The overall economy continued to grow, not at the same pace, of course, since interest rates are higher. However, what we see is some sectors of the economy has been slowing down more. Those sectors that are sensitive to interest rates, so for example, retail, restaurant, residential construction, these sectors are almost in a recession. But the Canadian economy, like you said, is still very resilient.
Which, of course, leaves government planning a budget with perhaps some more wiggle room. Things are better than they might have been. Do you think that therefore makes it easier to plan to spend on new items?
Well, yes, of course, because the unemployment rate, although it's increasing, the level of job is higher today than 12 months ago, which is kind of a surprise. When you increase interest rate, with the way we did over the last 18 months, you would expect that more people will lose their jobs. So the good news is the level of job is still very high. We are starting to see more slowdown of the job market, but the job market has been very resilient, which is a good news for Canadian and also for the government. When you prepare a budget, they are in a much better position than if we had lost thousands of jobs because of higher interest rate.
Of course, higher interest rates also affect government debt. Their borrowing costs have gone up. Should that be perhaps something that governments all over, not just federally, provincially, municipally, everywhere, think about as they put together budgets that are still in deficit territory?
Definitely. And we see at the provincial level where they already produced their budget that the level of debt has been really increasing. The deficits are high because, like you said, they are paying more in terms of interest payment. So what goes for household goes for government as well.
One of the big questions, of course, is how do we get more growth in the Canadian economy? There's been a lot of talk about productivity, which focuses on, it's hard to measure and hard to get your head around what that is, but per worker output. What do you think is the best thing a government can do, like in a document like next week's budget, to promote growth?
Well, I think productivity is the biggest challenge we have in Canada. Our productivity level has been going down compared to the U.S. For example, over the last 3 years, the U.S. economy has increased their productivity, which is not the case in Canada. We are underinvesting in technology in Canada, and that's one of the reasons why our productivity is not increasing. So I think government should help businesses to invest more in technology. We are, compared to the U.S., we are below the U.S., but also when we compare ourselves to other developed economies, we are below the average. Mm-hmm. So there's no reason for that, and I think that's a focus. That should be a focus for the government.
Not a ton of time here, about 30 seconds, but we have seen that U.S. economy continuing to grow against all expectations, much stronger than we thought. Good for us, I suppose. But what do you make of that we're weak while they are so strong?
Well, one of the big differences is the mortgage structure. Most Canadians have a mortgage for less than 5 years, so half of them have already renewed with higher interest rate. In the U.S., they could have a mortgage for 25 years. So the consumers in the U.S. has not been affected as much by higher interest rate. And that's the reason why the Canadian economy has been slowing down much more than the U.S. economy.
Pierre, so good to have you for this. Really appreciate it.
Thank you.
Pierre Cleroux is Chief Economist at Business Development Canada. Still ahead, what to expect from next week's budget and what you probably won't see. Stay with us.